Bloomberg News.
Investors are turning their attention to 2009. Our guest says the year will be catastrophic for the global economy. Marc Faber is managing director of Marc Faber Limited, publisher of the Gloom, Boom, and Doom report based in Hong Kong. He's joining us today on the Bloomberg Business Hotline from St. Moritz in Switzerland. Marc, good morning. Thanks for joining us.
Yes, good morning.
When you say a catastrophic year next year, give us some details.
Well, I think if you look back how the current crisis began, it began with a slowdown in credit growth, and then it led to slower home price appreciation, then to home prices going down, then to equities going down, and then essentially consumption slowing down and now declining. And just over the last 2 months, we had a total collapse in industrial production. In November, Japanese industrial production dropped 16% year on year. And so the next shoe to drop will be capital spending, because what happened is that consumption was increasing between 2001 and 2007. It drove industrial production, and then companies would expand their capital spending plans to meet the rising demand and rising industrial production. That goes into reverse. And as industrial production collapsed, it also dragged down commodity prices. So eventually the commodity producing countries in the world will have slower consumption, which will again hit industrial production in the countries that make goods and sell them to the raw material producers of the world. So we have a vicious circle on the downside that will take time to heal.
Is that just for the U.S. or is that globally?
No, that's globally. I mean, the U.S. is a less cyclical economy than, say, the manufacturing countries in Asia or the oil producers in the Middle East, because the U.S. doesn't produce much. It's a consumption-driven economy. So consumption goes down 5%. It hurts, but it's not the end of the world. Whereas if industrial production drops in some manufacturing countries by 15 to 20%, and at the same time capital spending goes down, and if oil prices drop from $145 down to less than 40, then it hurts the raw material producers very hard.
Which country gets hit the hardest?
Well, I think that raw material producers, commodity producers, will be hit very hard, in particular the Middle East, Central Asia, also Russia, and of course also countries like China, that essentially were the manufacturing hub of the United States.
So does China go into a recession, or does China escape?
I think they are already in recession now. The government statistics may not show it, because the one thing Chinese learned from America is how to doctor economic statistics. So they may still show some economic growth, but basically numerous sectors of the Chinese economy are in recession.
Well, I guess you'd make the argument that what would be very strong growth for the U.S. Would be a recession for China, right? Growth of 4 or 5%, somewhere in there?
Well, I think that if you go in China from, say, 10% annual growth down to 4% annual growth, it feels like a recession. But as I said, I personally think that the Chinese economy is already contracting.
Give us a sense of timing here. If the whole world is going to go into recession, or is there already, how long does it last?
Well, I think we fell off a cliff in October, November, and now in December. And the recession will spread at least for the next 6 to 12 months. Now, we may have a period during which the economies kind of stabilize and there could be a mild recovery. But I don't see a catalyst that will really drive renewed, sustained, long-term economic growth in the world for actually quite a few years.
Quite a few years? Could you narrow that down a little bit?
Well, I think that 2009 will be a write-off in terms of economic activity. I'm not talking here about asset markets, because asset markets may move quite independently, and we'll have to talk about this later. But for the global economy, I think it will be the worst, by far the worst recession since the Great Depression in the early 1930s.
Now, when you say the economy, the global economy just fell off a cliff this past fall, why was it so abrupt?
Well, I think that people woke up suddenly and saw that everything they had invested in 2008 and prior to that in 2007 had gone down. This is actually unprecedented, that you have globally a decline in home prices, you have a decline in commercial properties, you have a decline in equities, you have a decline in corporate bonds, and you have a decline in commodities. So, I mean, this wealth destruction is very, very significant. And in the United States, what it does is the public in America and households in America became accustomed to rising asset markets over the last 25 years. So they draw down their savings rate out of current income. And now that asset markets decline sharply, in my opinion, households will react the rational way. They will say, well, we can't save any more of our house going up in value. We can't save any more out of our equities going up in value. We better start saving out of current income, because if we don't do that, we'll have nothing to retire on.
Well, we have a couple of factors here in the U.S. That develops in summer. We have interest rates at practically zero, and
Yes.
we also have gasoline prices from more than $4 a gallon to about $1.60 as a national average. And that
Yes.
should be some help, right?
Yeah, to some extent it is a help, but it's not a help for the oil producers. And secondly, record low interest rates are debatable whether they help a lot. Because let's say you have borrowers and they borrow money. So, okay, they may pay less interest, but I can assure you on credit card, interest rates haven't gone down much. And on most mortgages, they haven't gone down much. But what it also does is say you have $1 million on deposits, or you're an investor and you own treasury bills, where's your income? So whereas if treasury bill rates are at 5%, maybe you can retire on treasury bills worth $10 million. But at 0% interest, you can't retire even on $10 million. So it creates another set of problems, in my opinion.
Mark, I wanted to ask you about how we define savings rate, because putting money in the bank is saving money, but your house being worth more is a form of savings, right? It boosts your net worth.
Yes, to some extent that's true. It's illusionary wealth because it's the same house. If you have a house and you don't borrow against it and it's worth, say, $500,000 and it doubles in price or it's cut in half price, because you have no borrowings, it's the same house and your standard of living doesn't change. The problem that occurred in America is that the equity in homes, which was in the 1950s still 80%, dropped every year and now is only around 43%. In other words, the borrowings against homes have increased dramatically, and all the homes that were purchased of all the homes that were purchased over the last 3 years, roughly 30% has now negative equity. So to save out of capital gains is a very questionable way of savings, because capital gains do not occur year in, year out, whereas saving out of current income leaves the economy with a pool of savings for capital spending.
Marc Faber, Marc Faber Limited, on the Bloomberg Business Hotline from San Moritz.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go on Bloomberg Television and